Before we begin, please remember that everything you are about to hear is for education purposes only. This is not financial advice, legal advice, or tax advice. I'm not telling you what to buy, when to buy it, or how much money to put into anything. Cryptocurrency is a volatile and speculative asset class, and you can lose some or all of the money you put into it. Please talk to a licensed financial professional before making any investment decisions, and never invest money you cannot afford to lose. Now let's get into it. I want you to picture something for a second. Imagine 10 of your friends all decide to learn how to swim on the same day. They have never been in a pool before. They have never taken a lesson, but they have heard swimming is fun. They have seen videos of people doing incredible tricks in the water and they are excited. So all 10 of them jump into the deep end of at the same time with no instructor, no flotation device, and no plan. What do you think happens? A few of them might paddle around and figure it out through sheer luck, but most of them are going to struggle. Some of them are going to panic, and a few of them might actually get hurt. That is, in a nutshell, what happens to most people who enter the cryptocurrency world for the first time. They jump into the deep end without ever learning to swim first. You have probably heard some version of a statistic floating around that says something like 95% of beginners lose money on their first crypto investment. I want to be very upfront with you about that number right at the start of this episode, because being honest with you matters more to me than being dramatic. That specific 95% figure is not something that comes from one single official peer reviewed government study that everybody agrees on. It's a number that gets repeated a lot in the crypto education space, and it's based on a mix of trading platform data, exchange research, and observed patterns from market analysts who study how new investors behave. Different studies and different platforms report different numbers, some higher, some lower, but almost all of them point in the same general direction. The overwhelming majority of the first time crypto investors either lose money, break even after accounting for fees, or less at or sell at a loss out of fear before they ever see meaningful gains. So whether the true number is 80% or 90% or 95%, the underlying truth doesn't change. Most beginners struggle badly with their first crypto experience, and today we are going to spend the next 3 hours understanding exactly why that happens in plain language from the ground up, assuming you know absolutely nothing about crypto going in. This episode is not designed to scare you away from cryptocurrency. It's designed to do the opposite. I want you to walk away from this 3 hours with a real foundational understanding of what cryptocurrency actually is, how the market behaves, and most importantly, the specific mistakes that trip up almost every single beginner. Because here's the thing, every single mistake we are going to talk about today is avoidable. Nobody is born knowing how to manage risk in a volatile market. Nobody is born knowing what a private key is or how a blockchain works. These are learnable skills. The people who succeed in crypto over the long run are not smarter than everyone else. They simply took the time to understand the fundamentals before they put real money on the line. That's what we are doing together right now. Let's start at the very beginning, because to understand why beginners lose money, you first have to understand what they are actually buying. A lot of people jump into crypto having heard the word Bitcoin or Ethereum or some meme coin their co-worker mentioned without ever stopping to ask the basic question, what is this thing really? So let's slow down and build this from the ground up. Money in its most basic form is just a shared agreement. Thousands of years ago, humans traded goods directly with each other. If you had chickens and I had wheat, we would trade chickens for wheat. This is called bartering. But bartering has a huge problem. What if I have wheat, but you don't want wheat, you want shoes? Now we can't make a trade unless we find someone else willing to trade shoes for wheat and then trade that wheat for your chickens. It's clunky, it's inefficient. So over time, human societies invented a easier system. Instead of trading goods directly, they agreed to use a middle object that everyone accepted as valuable. This started with things like seashells, salt, and precious metals like gold and silver. Eventually, governments started printing paper money and stamping coins, and everyone agreed that these pieces of paper and metal represented value, even though the paper itself is basically worthless on its own. $100 bill is just a piece of cotton and linen with ink on it. It has no real usefulness by itself. You can't eat it, you can't build a house with it. It only has value because millions of people collectively agree that it does, and because the government backs it and insists you can use it to pay your taxes and your debts. This is a really important idea to understand because it applies directly to cryptocurrency. Money at its core is not about the physical object, it's about shared trust and agreement. For most of modern history, that trust was managed by a small number of powerful institutions. Governments controlled the currency, central banks decided how much money to print, regular banks controlled your access to that money, verified your transactions, and kept records of who owned what. If you wanted to send money to your cousin in another country, you had to go through a bank, and that bank had to work with other banks, and there were fees and delays, and sometimes your transaction could be blocked or reversed by someone with more power than you. In the year 2008, the world experienced a massive financial crisis. Major banks around the world had made extremely risky financial decisions, and when those decisions fell apart, it triggered a global recession. Millions of people lost their jobs, their homes, and their savings, while some of the very institutions responsible for the crisis received massive bailouts from taxpayer money. This event caused a lot of people to lose trust in the traditional banking system. They started asking a very fundamental question: why do we need to depend on banks and governments to manage our money? Is there a way to create a currency that doesn't rely on any single company or government, one that can't be manipulated by any one powerful entity, one where the rules are fixed and transparent for everyone to see? In late 2008, shortly after that financial crisis, a person or a group of people using the name Satoshi Nakamoto established a document describing a new kind of digital currency called Bitcoin. To this day, nobody knows the true identity of Satoshi Nakamoto. It could be one person, it could be a group of people. This is a documented, verified fact, not a rumor, and it remains one of the most interesting mysteries in modern technology. The idea behind Bitcoin was radical for its time. Instead of a bank or government keeping track of who owns what money, a giant network of computers all around the world would keep track together. Every single transaction would be recorded on a shared public ledger, and thousands of computers would all have to agree that a transaction was valid because it could be added to that ledger. No single person or company would control it. It would be decentralized, meaning power and control was spread out across many participants instead of concentrated in one place. This is where the word blockchain comes in, and I want to explain it using an analogy rather than technical jargon, because the technical explanation tends to confuse people who are new to this. Imagine a small town where everybody keeps a physical notebook. Every single time anyone in town buys or sells something, they write it down in their own notebook and then they shout it out loud so everyone else in town can write the same thing down in their notebooks too. So if Sarah pays Tom $20 for a bicycle, everyone in town writes down, quote, Sarah paid Tom $20 for a bicycle in their own notebook. Now imagine that every single page of everyone's notebook has to match every other page exactly. If someone tries to speak in a fake entry, like pretending they received money they never actually received, that fake entry won't match what everybody else wrote down, and the town will immediately notice the mismatch and reject it. That is essentially what a blockchain is. It's a shared public record of transactions that is copied across thousands of computers around the world called nodes, and everyone's copy has to match. This makes it extremely difficult for any single person to fake a transaction or steal money by manipulating the records, because they would have to somehow convince thousands of independent computers around the world to all agree to the same fake information at the same time, which is enormously difficult by design. The word blockchain literally describes the structure. Transactions get bundled together into groups called blocks. Each new block gets attached to the previous block, forming a chain that goes all the way back to very first transaction ever recorded. This creates a permanent, unchangeable history. Once a transaction is confirmed and added to the blockchain, it becomes extremely difficult to alter or remove. This is very different from a bank's private database, where bank has full control and could in theory alter records, freeze your account or reverse a transaction. So Bitcoin was created as an experiment in this idea of decentralized digital money. For the first several years of its existence, it was mostly used by a small community of computer programmers, cryptographers, and hobbyists. It had very little monetary value. There's a well-known, well-documented story about a programmer who in the year 2010 paid 10,000 Bitcoin for two pizzas, just to prove that Bitcoin could be used to buy something in the real world. At today's prices, that would represent an amount of money in the hundreds of millions of dollars. That story is often used to illustrate two things at once. First, how far Bitcoin's price has grown over the years. Second, how unpredictable and speculative it was in its early days, when nobody knew what it would become, if anything at all. Over the following decade, Bitcoin slowly gained attention. Other cryptocurrencies started to emerge too, built on similar ideas but with different features. Ethereum, created by a programmer named Vitalik Buterin and launched in 2015, introduced something called smart contracts, which are self-executing pieces of code that live on a blockchain and automatically carry out an agreement where certain conditions are met. Think of a vending machine. You put money in, you select a snack, and the machine automatically gives you that snack without needing a human cashier to approve the transaction. A smart contract works in a similar way, but for much more complex digital agreements like lending money, creating digital art ownership records, or building entirely new financial applications without a bank in the middle. Over time, thousands of different cryptocurrencies have been created. Some aim to be digital money like Bitcoin, some aim to power decentralized applications like Ethereum, some are essentially jokes or memes that gain popularity through social media and internet culture rather than any specific technological innovation. And unfortunately, some are created purely as scams designed to separate new investors from their money. Now, why does all of this history matter for understanding why beginners lose money? Because most beginners skip this entire foundation. They hear a friend, a coworker, an influencer, or a headline mention that some cryptocurrency went up in value very quickly, and they jump straight to the question of how do I buy this and make money without ever understanding what they are actually buying, why it has value, how the market behaves, or what risks are involved. It's like trying to play a complicated sport at a competitive level without ever learning the basic rules first. You might get lucky once or twice, but over time, the players who understand the fundamentals will consistently outperform the ones who don't. Let's talk about mistake number one. And I genuinely believe this is the single biggest reason beginners lose their first crypto investment. It's a lack of basic research before putting money in. This is sometimes called buying blind. A beginner sees a coin mentioned somewhere, sees a chart that's been going up, gets excited by the possibility of quick gains, and buys it. That same day, sometimes within minutes of hearing about it for the first time. They don't research what the project actually does. They don't check who created it. They don't look into how long it has existed, what problem it claims to solve, whether the price increase they are seeing is based on real adoption and use or purely on hype and social media attention. Here's a fact versus opinion distinction that's important to make here. It is a fact that cryptocurrency prices can be extremely volatile, meaning they can rise or fall by large percentages in very short periods of time, sometimes within hours. This volatility is well documented and widely reported in financial researchers by financial researchers and news organizations. It is an opinion, not a fact. When someone tells you that a specific coin is guaranteed to go up in value or that you are getting in early on the next big thing, nobody, no matter how confident they sound, can guarantee future price movements of any cryptocurrency. Anyone who tells you otherwise is either misinformed or trying to profit from convincing you to buy something. A common pattern that happens with beginners looks like this. A new cryptocurrency, sometimes called an altcoin, meaning any coin that isn't Bitcoin, gets promoted heavily on social media platforms. Influencers post about how much money they supposedly made. Comment sections fill up with people claiming incredible returns. This creates a psychological effect called fear of missing out, often abbreviated as FOMO. The beginner sees everyone around them seemingly getting rich and they panic that they will miss the opportunity if they don't act immediately. So they buy in, often at a price that has already risen dramatically due to all this hype and buying pressure. Shortly after, the price often falls, sometimes very sharply, because the people who bought early, sometimes including the very people who created the coin, sell their holdings to the new buyers who just came in due to the hype. This is sometimes referred to informally as a pump and dump pattern. The price gets pumped up through hype and coordinated promotion, and then the earlier holders dump their coins onto the newer buyers, causing the price to crash. The beginner who bought at the peak of the hype is left holding a coin that has lost a significant portion of its value, sometimes very quickly. This is not a rare, unusual event. This pattern has repeated itself thousands of times across the history of cryptocurrency, with different coins, different social media platforms, and different groups of victims, but the same underlying structure every single time. The specific coins change, the pattern doesn't. So what does proper research actually look like in practical terms for someone brand new to this space? It doesn't need to be complicated, and it doesn't require a finance degree. Before buying any cryptocurrency, a responsible beginner would want to understand a few basic things. What actual problem does this project claim to solve, and does that explanation make logical sense to a normal person, or does it sound like vague marketing language with no real substance? How long has this project existed, and does it have an actual functioning product, or is it just an idea and a website? Who created it, and are those people publicly known and accountable, or completely anonymous with no track record? It is the price increase you're seeing driven by real growing usage and adoption, or purely by social media buzz and promotional hype? These questions won't guarantee you avoid losses, because even well researched investments can lose value in a volatile market, but they dramatically reduce your chances of falling for the most obvious trap that catch inexperienced beginners. Let's move to mistake number two, which is closely connected to the first one. This is investing based on emotion rather than a plan. Human beings are wired with certain psychological instincts that serve us well throughout evolutionary history, but that work against us in financial markets. One of the strongest of these instincts is herd behavior. When we see a large group of people doing something, our brains are wired to assume that group must know something we don't, and we feel a strong pull to join them. This made sense for early humans. If everyone in your tribe suddenly started running, it was probably smart to run too, because they might have spotted a predator you hadn't noticed yet. But in financial markets, herd behavior often leads people to buy at exactly the wrong time, when an asset's price is already inflated by other people's excitement, and to sell at exactly the wrong time when panic spreads through a crowd and everyone rushes for the exit simultaneously. Cryptocurrency markets are particularly susceptible to this kind of emotional herd behavior for a few specific reasons. First, the market operates 24 hours a day, 7 days a week, unlike traditional stock markets, which have set opening and closing hours. This means there's no natural pause for people to step back, calm down, and think rationally. Prices can move dramatically at 3 in the morning while most traditional investors are asleep. Second, cryptocurrency is heavily discussed on social media platforms where information spreads instantly and emotions can be amplified within minutes through viral posts, videos, and comment threads. Third, because the entire asset class is relatively new and still not fully understood by most of the general public, there's less institutional stability and more room for speculation, wild rumors, and swings driven by pure sentiment rather than measurable business fundamentals. A beginner who invests based on emotion typically follows a predictable and unfortunate cycle. They see a coin's price rising rapidly, they feel excitement and fear of missing out, and they buy near the top at that price increase. Then, when the price naturally corrects downward, which is an extremely common pattern in volatile markets, they feel fear and panic. Instead of sticking to any kind of plan because they never had one to begin with, they sell at a loss to stop the emotional pain of watching their investment shrink. Later, if the price recovers, which is it sometimes does and sometimes doesn't, they feel regret, and the cycle of emotional reaction begins all over again with the next coin that catches their attention. Contrast this with an approach based on a plan made in advance during a calm state of mind before any money is actually invested. This doesn't mean the plan guarantees profit, it simply means decisions are made deliberately rather than reactively. This might involve deciding in advance roughly how much money you are willing to allocate to a highly volatile speculative asset class, a decision made with a clear head ideally with input from a licensed financial professional who understands your full financial picture. It might involve deciding in advance under what specific circumstances you would consider selling rather than making that decision emotionally in the middle of a price swing. None of this eliminates risk. Nothing eliminates risk in a volatile market. But planning in a calm state rather than reacting in an emotional state tends to produce more consistent, thoughtful behavior over time. Let's pause here for a moment and recap everything we have covered so far, because we have covered an important foundation and I want to make sure it's locked in before we move forward. We started by exploring what money actually is at its core, a shared agreement of trust and value, and we traced the history from bartering to physical currency to the banking system and eventually to the financial crisis of 2008 that led to the creation of Bitcoin. We explained blockchain using the notebook analogy, where a shared duplicated ledger across thousands of computers makes it extremely difficult to fake transactions or alter history. We touched on Ethereum and the idea of smart contracts, which are self-executing digital agreements. Then we moved into the first major reason beginners lose money, which is a lack of basic research before investing, often driven by hype, social media promotion, and the fear of missing out, sometimes leading into pump and dump patterns where all early holders profit at the expense of new uninformed buyers. And we just finished discussing the second major reason, which is making investment decisions based on raw emotion rather than any kind of calm deliberate plan, a pattern that tends to result in buying near price peaks out of excitement and selling near price valleys out of panic. Now let's continue building on this foundation and talk about mistake number 3, which is one of the most financially damaging mistakes a beginner can make. This is investing money that they cannot actually afford to lose. I want to spend real time on this one because it's not just a technical mistake, it's a mistake that can affect someone's actual life and well-being, not just their investment portfolio. Here's a basic, widely accepted financial principle, and this is a fact, not an opinion. Highly volatile speculative assets like cryptocurrency should generally only be approached with money that a person can genuinely afford to lose entirely without it affecting their ability to pay rent, buy groceries, cover medical expenses, or meet other essential financial obligations. This principle isn't unique to cryptocurrency. It applies to any high risk, high volatility investment. The reason this principle exists is straightforward. When you invest money you actually need for survival or for near-term essential expenses, you put yourself in a psychologically and financially dangerous position. If the investment loses value, and remember, cryptocurrency is well documented to be capable of losing significant value in short periods, you're not just facing a paper loss on a spreadsheet, you're facing a genuine crisis in your actual life. Unfortunately, this is an extremely common mistake among crypto beginners, and there are documented patterns of behavior that illustrate this. Some beginners have used money set aside for rent or bills. Some have taken out loans, borrowed from credit cards or borrowed from family members specifically to invest in cryptocurrency, believing that the potential gains would far outweigh the cost of borrowing. Some have used money meant for emergency savings, money that exists specifically to cover unexpected life events like a medical bill or a car repair. When any of these approaches are used and the investment loses significant value, which happens to a very large percentage of speculative crypto investments, the consequences extend far beyond a simple financial loss. They can lead to missed rent payments, damaged credit, strained family relationships, and significant emotional and psychological stress. I want to be really clear that this isn't about telling you how to manage your own money, because that's not my place and everyone's financial situation is different. This is simply on an observation of a well documented pattern. The beginners who suffer the most severe consequences from crypto losses are almost always the ones who invested money they needed for essential living expenses rather than money that was genuinely discretionary, meaning money left over after covering necessities, debts, and a reasonable emergency fund. If you are ever considering investing in cryptocurrency or honestly any volatile asset, it's worth having an honest conversation with yourself or ideally with a licensed financial advisor about whether the money you're considering using is money you could genuinely afford to lose without it disrupting your life. Let's move on to mistake number 4, which involves something a lot of beginners don't even realize is a risk until it's too late. This is falling victim to scams, fraudulent platforms, and fake investment schemes. Unfortunately, the cryptocurrency space has attracted a significant number of bad actors precisely because it's a relatively new industry. It involves technology many people don't fully understand, and transactions on most blockchains cannot be reversed once completed. This last point is worth repeating because it's critically important. Unlike a traditional bank transaction where a fraudulent charge can sometimes be disputed and reversed, most cryptocurrency transactions are permanent and irreversible once confirmed on the blockchain. If someone tricks you into sending your cryptocurrency to them, there is often no bank, no customer service line, and no government agency that can simply reverse that transaction and give your money back. This is a documented, well known characteristic of how most blockchain transactions work, and it's exactly why scammers are drawn to this space. Let's go through some of the most common scam patterns that beginners fall for, described in general terms so you can recognize the underlying structure regardless of what specific name or story a scammer might use. One extremely common pattern is what's sometimes called a guaranteed returns scheme. A person, platform, or group promises that if you send them cryptocurrency or regular money, they will use some special trading strategy, algorithm, or insider connection to generate a guaranteed profit for you, often described in very specific and confident sounding numbers like doubling your money within a set number of days. Here is an important fact to hold on to. No legitimate investment of any kind, cryptocurrency or otherwise, can honestly guarantee specific returns within a set time period. Financial markets are inherently unpredictable. Anyone who guarantees you a specific profit is not describing a real investment. They are describing a scam, full stop. This pattern is sometimes structured as what's called a Ponzi scheme, where early participants are paid using money collected from newer participants rather than from any actual underlying investment activity. This creates the illusion of legitimate returns for a while, which encourages victims to invest more money and recruit friends and family until eventually the scheme collapses because there isn't enough new money coming in to pay the earlier participants, and the vast majority of people involved lose most or all of their money. Another extremely common pattern is called a romance scam, sometimes also referred to informally as pig butchering, a term used by researchers and journalists to describe a scam where a victim is slowly built up over weeks or months, similar to fattening an animal before slaughter, before being financially exploited. In this scam, someone builds what appears to be a genuine personal relationship with a victim, often through dating apps, social media, or even seemingly random text messages over a period of weeks or months. They invest real time and effort into appearing caring, trustworthy, and emotionally invested in the relationship. Eventually, they introduce the idea of a cryptocurrency investment opportunity, often showing the victim a fake trading platform with impressive looking but entirely fabricated profit numbers. The victim, believing they are in a genuine relationship and seeing what appears to be real proof of profit, sends increasing amounts of money over time. When the victim eventually tries to withdraw their supposed profits, they are told they need to pay additional fees or taxes first, and after paying those, the scammer disappears entirely and the victim never recovers any of the money. Another common pattern involves fake cryptocurrency exchanges or wallet applications. Scammers create websites or mobile apps that look nearly identical to legitimate, well-known cryptocurrency platforms. Beginners not yet familiar with what the real platform looks like sign up on the fake version, deposit real money, and either have that money stolen directly or later find they cannot withdraw their funds at all. A related pattern involves fake customer support. A beginner might have a genuine question or issue with a legitimate platform, search for help online, and unknowingly contact a scammer pretending to be customer support, who then convinces the beginner to share sensitive account information or send funds directly to the scammer under the guise of resolving the issue. Another significant pattern involves fraudulent tokens, sometimes called rug pulls. In this scenario, developers create a brand new cryptocurrency token, promote it aggressively on social media, encourage people to buy in, and then once a significant amount of money has flowed in, the developers withdraw all the value from the project and disappear, leaving the token essentially worthless. This term rug pull is widely used and documented across crypto news coverage and research, describing a very real and repeated pattern in the industry. So how does a beginner protect themselves from these kinds of scams? There are some general practical safety principles that apply across almost all of these scenarios, and I want to walk through them clearly because this really might be the single most important practical actionable section of this entire episode. First, treat any guarantee of specific profits as an immediate red flag, regardless of how confident or credible the person or platform seems. Legitimate investments never guarantee specific returns. Second, be extremely cautious of anyone you have met exclusively online, especially through dating apps or unsolicited messages, who eventually brings up a cryptocurrency investment opportunity, specifically if they show you screenshots of supposed profits on an unfamiliar platform. Third, always independently verify any platform before depositing money by searching for its name along with words like review or scam, and checking whether it's a widely recognized established exchange rather than relying solely on links or apps sent to you directly by someone you don't know extremely well in real life. Fourth, never share your private keys or your wallet's recovery phrase, sometimes called a seed phrase, with anyone under any circumstances ever. We will explain exactly what these terms mean shortly, but for now, just know that legitimate platforms and legitimate customer support will never under any circumstances ask you for this information. Fifth, be skeptical of urgency and pressure. Scammers frequently create a false sense of urgency, telling you that an opportunity will disappear if you don't act immediately, specifically because urgency prevents people from taking the time to research and think clearly. Let's shift now to mistake number 5, which is closely related to security but distinct from scams specifically. This is poor personal security practices that lead to losing access to your own cryptocurrency even without any scammer directly involved. To understand this mistake, we need to explain a few few technical concepts clearly, because this is genuinely one of the most confusing areas for total beginners, and misunderstanding it can lead directly to permanent financial loss. When you own cryptocurrency, you are not storing physical coins somewhere. What you actually own is the right to move a certain amount of value that's recorded on the blockchain, and that right is controlled by something called a private key. Think of a private key as an extremely long, complex password, except unlike the regular password, if you lose it, there is no company, no bank, and no customer service department that can reset it for you or recover it on your behalf. Your private key is the only proof of ownership. Whoever possesses the private key associated with a certain amount of cryptocurrency effectively controls that cryptocurrency regardless of who originally purchased it. Because private keys are extremely long and complicated, most wallets, which are the software or hardware tools used to manage your cryptocurrency, separate something called a seed phrase, sometimes called a recovery phrase. This is typically a series of 12 or 25, 24 common English words presented in a specific order that can be used to regenerate your private keys and recover access to your funds if you ever lose your device or need to restore your wallet on a new one. This seed phrase is, in practical terms, the master key to your entire cryptocurrency holdings. Anyone who obtains your seed phrase can access and control every asset connected to that wallet from anywhere in the world without needing your device, your password, or your permission. This creates two opposite but equally dangerous risks for beginners. The first risk is losing your own access. If you write down your seed phrase and then lose that piece of paper, or you store it only in your memory and forget it, and your device breaks and you never backed up the phrase anywhere, you can permanently and irreversibly lose access to your own cryptocurrency with absolutely no way to recover it. There is no forgot password button, there is no customer service line that can restore it. This isn't a hypothetical risk, it's a well documented, widely discussed phenomenon in the cryptocurrency industry. Researchers and blockchain analytics companies have published estimates suggesting that a meaningful percentage of all Bitcoin ever created, sometimes cited in the range of 15 to 20% by various blockchain analysis firms, may be permanently inaccessible due to lost private keys or forgotten passwords. These specific percentage estimates vary between different analytics companies and studies, so treat the exact figure with some healthy skepticism, but the underlying phenomenon, permanent loss due to lost keys, is well documented and broadly agreed upon across the industry. The second opposite risk is having your seed phrase stolen by someone else, whether through a scam, through hacking, or through simple carelessness like storing a photo of your seed phrase in a cloud storage account that later gets compromised, or telling a family member or friend who later turns out to be untrustworthy, or accidentally posting a screenshot online that included the phrase in the background. So what does responsible security actually look like for a total beginner? Again, I want to be practical and clear here without giving you personalized advice, just general, widely accepted principles. Many beginners start by keeping their cryptocurrency directly on the exchange where they purchased it, essentially treating the exchange like a bank account. This is sometimes convenient, but it means you don't actually control the private keys yourself. The exchange does, which introduces a different kind of risk that we will discuss shortly when we talk about exchange failures. As people become more experienced, many choose to move their cryptocurrency into what's called a personal wallet, where they do control the private keys directly. Within personal wallets, there are software wallets, which are apps on your phone or computer, and hardware wallets, which are small physical devices specifically designed to store private keys offline, disconnected from the internet, making them significantly harder for remote hackers to access. Whichever method someone chooses, a few general security principles tend to apply broadly. Seed phrases should never be stored digitally in an easily accessible place like a photo or on your phone, a note in your email, or a file in cloud storage, because if the digital location is ever hacked, your cryptocurrency can be stolen instantly and irreversibly. Seed phrases are often instead written down physically on paper or sometimes on more durable materials like metal and stored somewhere secure and private. It's also widely recommended to never share your seed phrase with anyone ever under any circumstance, including people claiming to be customer support representatives, since this information is never legitimately requested by real platforms. Let's take another moment to recap what we have covered in this middle section, because we have gone through some dense but critical material. We discussed the danger of investing money you cannot afford to lose, and how this mistake tends to cause the most severe life disrupting consequences compared to other mistakes. We went through several major categories of scams, including guaranteed return schemes, romance scams, sometimes called pig butchering, fake exchanges, and fake customer support, and rug pulls where developers abandon a project and disappear with the funds. We covered practical ways to recognize and avoid these scams, including skepticism toward guaranteed returns, verifying platforms independently, and never sharing private keys or seed phrases. And we just finished explaining what private keys and seed phrases actually are, why losing them can mean permanently losing your cryptocurrency with no recovery option, and some general principles around storing this information securely. Now let's move into mistake number 6, which involves a slightly different category of risk related to the platforms and exchanges people use to buy and hold cryptocurrency in the first place. This is for failing to understand the risks associated with centralized exchanges and third-party platforms. A centralized exchange is a company that allows you to buy, sell, and often store cryptocurrency through their platform, similar to how you might use a brokerage app to buy stocks. Some of these platforms are large, well established companies that have operated for many years and built strong reputations. Others are small, newer, or less regulated. Here's an important historical fact that every crypto beginner should know. Throughout the history of cryptocurrency, there have been several well documented, publicly reported cases of major exchanges either being hacked and losing large amounts of customer funds, or collapsing due to internal fraud or mismanagement, resulting in customers losing access to money and cryptocurrency they had stored on that platform. One of the earliest and most well known examples happened in 2014, when a major exchange called Mt. Gox, which at the time handled a very large percentage of global Bitcoin trading, collapsed after revealing that a substantial amount of customer Bitcoin had been lost. reportedly due to a combination of hacking and internal mismanagement. This was widely reported in financial and technology news at the time and remains as well a well documented case study discussed in cryptocurrency education to this day. More recently, in November of 2022, a major exchange called FTX, which had been one of the largest and most well known exchanges in the world at the time, collapsed very suddenly after it was revealed that the customer funds had been improperly used, resulting in a massive loss of customer money and lending and leading to criminal charges against the company's founder. This is also widely and publicly reported, well documented news covered extensively by major financial news organizations, and it serves as one of the most significant cautionary examples in the entire history of cryptocurrency industry. I am sharing these historical examples not to scare you, but because understanding them is directly relevant to understanding risk. There's a phrase that's become common within the cryptocurrency community, which goes, not your keys, not your coins. This phrase is used to express the idea that if you don't personally control the private keys of your cryptocurrency and instead rely on exchange to hold it for you, you're placing trust in that company's honesty, security practices, and financial stability, similar to how you trust a bank. The difference is that traditional bank deposits in the United States are typically insured up to a certain amount by Federal Deposit Insurance Corporation, commonly known as the FDIC, which is a real well-established federal program. Cryptocurrency holdings on exchanges generally do not have this same kind of government-backed insurance protection, meaning if an exchange fails or is hacked, customers may have limited or no ability to recover their funds depending on the specific circumstances and any bankruptcy proceedings that follow. This doesn't mean every exchange is dangerous or untrustworthy. Many exchanges have operated for years with strong security track records and have never had a major incident, but it does mean that beginners should understand this distinction clearly. Money sitting in a well established, insured, traditional bank account carries a different risk profile than cryptocurrency sitting on an exchange, even a large and reputable one. Understanding this distinction rather than assuming an exchange functions exactly like a bank is an important part of managing expectations and risk as a beginner. Let's move to mistake number 7, which involves a more technical trading concept but one that has caused enormous financial damage to countless beginners. This is the use of leverage and margin trading without properly understanding how it works. Leverage is a tool offered by many cryptocurrency trading platforms that allows a person to trade with more money than they actually have by essentially borrowing funds from the platform to increase the size of their position. For example, if a platform offers what's called 10 times leverage, a person with $100 could open a trade worth $1,000 10 times their actual money. Here's why this is so dangerous for beginners. Specifically, leverage doesn't just multiply your potential profits, it multiplies your potential losses by the exact same amount, and it introduces a risk that doesn't exist when you simply buy and hold cryptocurrency without leverage. That risk is called liquidation. When you trade with leverage, the platform sets a certain price level where if the market moves against you by a large enough amount, your entire position gets automatically closed out and you lose the money you put in, sometimes within minutes. Even if the underlying asset's price recovers shortly afterward, using the earlier example with 10 times leverage, if the price of the asset you are trading moves against you by just 10%, your entire initial investment can be completely wiped out. through liquidation. Even though a 10% price movement is an extremely common, unremarkable event in cryptocurrency markets, sometimes happening within a single day. This is a critical fact to understand. Leverage trading is fundamentally different from simply buying and holding cryptocurrency. When you buy and hold, in most cases, even if the price drops significantly, you still own the same amount of cryptocurrency. And if the price eventually recovers, so does the value of your holding, assuming you haven't sold at a loss in the meantime. With leverage trading, a large enough price swing against your position can wipe out your investment entirely and permanently, regardless of what happens to the price afterward, because your position gets forcibly closed by the platform before any recovery can happen. Countless beginners, drawn in by the appeal of amplifying their potential profits, have used leverage trading without truly understanding the liquidation risk involved, and have lost their entire investment within hours or even minutes, often during ordinary unremarkable price swings that experienced traders would consider completely normal market behavior. This is widely discussed and documented across trading platform statistics, financial news coverage, and academic research into retail trading behavior, showing consistently that a large majority of retail traders using leverage products lose money over time. Some financial regulators around the world have published research and even implemented restrictions on offering these products to retail investors, specifically because of how consistently damaging they have proven to be for inexperienced traders. This isn't opinion, it's a well documented pattern across financial markets broadly, not just cryptocurrency specifically. For a total beginner, the practical takeaway here is fairly simple to state. Even though the underlying mechanics are complex, leverage and margin trading carry substantially higher risk than simply buying and holding cryptocurrency, and this additional risk is very poorly understood by most people before they try it for the first time, often leading to rapid complete losses that catch beginners completely off guard. Let's move to mistake number 8, which is subtler than some of the previous mistakes but still financially significant over time. This is ignoring fees, taxes, and the true cost of frequent trading. When someone buys or sells cryptocurrency, whether through an exchange or by moving cryptocurrency between wallets, there are typically fees involved. Exchanges usually charge a trading fee for every purchase or sale, and moving cryptocurrency on certain blockchains requires paying what's called a network fee, sometimes referred to as gas fees on certain blockchains like Ethereum, which compensates the computers called miners or validators that process and confirm transactions on the network. For a beginner, making a single purchase and holding it for a long period of time, these fees are usually a relatively minor consideration. But for a beginner who trades frequently, buying and selling repeatedly based on short-term price movements, these fees can accumulate significantly over time and quietly erode overall returns, even if a decent number of individual trades happen to be profitable. This connects back to the emotional trading pattern we discussed earlier. A beginner who panics and sells during a dip, then buys back in when the price recovers, then panics again during the next dip, isn't just making emotionally driven decisions. They are also paying transaction fees repeatedly with each trade, which adds an additional quiet drag on their overall returns that many beginners don't fully account for when evaluating how their strategy actually performed. Taxes represent another commonly overlooked factor. In the United States, the Internal Revenue Service, commonly known as the IRS, treats cryptocurrency as property for tax purposes, which is a well established, publicly documented tax policy. This generally means that selling cryptocurrency for a profit can create a taxable event similar to selling stock for a profit, and in some cases even trading one cryptocurrency for another without ever converting to regular dollars can also be considered a taxable event under current guidance. Many beginners are genuinely unaware of these tax obligations when they start trading, and later discover, sometimes with real financial and legal stress, that they owe taxes to trading activity from previous years that they never properly tracked or reported. This is exactly why we mentioned at the very beginning of this episode that this content is educational only and not tax advice. Tax laws are complex, they can change over time, and they can vary depending on someone's individual circumstances. If you ever engage in cryptocurrency transaction, it's genuinely important to consult with a qualified tax professional who can advise you based on your specific personal situation rather than relying on general information from a podcast, however well researched that information may be. Let's move into mistake number 9, which relates to a lack of diversification and an overly concentrated risk approach. Diversification is a widely accepted financial principle that essentially means not putting all your resources into a single asset or a single type of investment, but instead spreading risk across multiple different things. This principle exists because different assets tend to behave differently under different economic conditions, and spreading investment across multiple assets can help reduce the impact of any single asset performing poorly. A common mistake among crypto beginners is putting a significant portion of their available investment funds into a single cryptocurrency, often one that's currently generating a lot of hype and social media attention, rather than spreading their approach more broadly or considering cryptocurrency as just one small piece of a much broader financial picture that might include things like retirement accounts, traditional stock market investments, and cash savings. When a beginner concentrates heavily into one single available volatile asset, they expose themselves to the maximum possible impact if that specific asset performs poorly compared to someone whose overall financial picture is spread more broadly. This doesn't mean diversification eliminates risk entirely. Even a diversified portfolio can lose value, especially during broad market downturns that affect many assets simultaneously. But concentrating heavily into a single highly speculative asset is widely recognized in financial research as a higher risk approach compared to a more diversified one. Let's move to mistake number 10, which is closely related to several things we have already discussed but deserves its own dedicated explanation. This is a complete lack of any exit strategy or long-term plan before ever entering an investment. An exit strategy simply means having some general sense decided in advance during a calm state of mind of what circumstances might lead you to sell an investment, rather than making that decision reactively in the middle of an emotional price swing. Beginners without any exit strategy often find themselves making decisions purely based on how they feel at any given moment, which, as we discussed earlier, tends to produce poor timing, buying during hype driven price peaks and selling during panic driven panic price valleys. Having some kind of general plan again doesn't guarantee good outcomes, because markets are inherently unpredictable, and even well thought out plans can be affected by circumstances nobody could have reasonably anticipated. But a general plan does tend to produce more consistent, deliberate behavior compared to a complete absence of any plan at all, where every decision is made reactively in the heat of the moment. Now let's take a broader look at all 10 of these mistakes together, because when you step back and look at the full picture, a clear pattern emerges. Almost every single one of these mistakes traces back to the same underlying root cause: a lack of foundational education before real money gets involved. The beginner who researches a project thoroughly before investing is less likely to fall for hype driven pump and dump schemes. The beginner who understands their own emotional tendencies and plans in advance is less likely to buy at emotional peaks and sell at emotional valleys. The beginner who only invests money they can genuinely afford to lose avoids the most severe life disrupting consequences. The beginner who understands common scam patterns is far less likely to fall victim to them. The beginner who understands private keys and seed phrases is far less likely to permanently lose access to their own funds. The beginner who understands the difference between exchange custody and personal custody makes more informed decisions about where and how to store their cryptocurrency. The beginner who understands leverage and liquidation avoids one of the fastest, most devastating ways to lose an entire investment. The beginner who accounts for fees and taxes has a more accurate picture of their true returns. The beginner who diversifies reasonably avoids excessive concentration in a single volatile asset. And the beginner who has some kind of plan decided in advance tends to make more consistent, less emotionally reactive decisions over time. None of this education guarantees profit. I want to be extremely clear about that, because I never want to leave you with the impression that understanding these concepts means you will definitely make money in cryptocurrency. Markets are unpredictable, and even highly educated, experienced investors experience losses. What this education does provide is a dramatically reduced likelihood of falling into the most common, well documented, and often completely avoidable traps that catch the vast majority of uninformed beginners. Let's take a longer recap here, because we have now covered a tremendous amount of material, and I want to make sure everything is organized clearly in your mind before we move into some additional important sections. So far in this episode, we have explored the history and purpose of cryptocurrency, starting with the basic concept of money as shared trust, moving through the 2008 financial crisis and the creation of Bitcoin, and explaining blockchain technology through the shared notebook analogy. We then worked through 10 major well documented reasons why beginners tend to lose money on their first cryptocurrency investment. Reason 1 was a lack of basic research before investing, often driven by hype and fear of missing out. Reason 2 was making decision based on raw emotion rather than a calm, deliberate plan. Reason 3 was investing money that couldn't genuinely be afforded to lose, which tends to produce the most severe life disrupting consequences. Reason 4 covered common scam patterns, including guaranteed returns schemes, romance scams, fake platforms, and rug pulls, along with practical ways to recognize and avoid them. Reason 5 explained private keys and seed phrases and how poor personal security practices can lead to permanent unrecoverable loss of funds. Reason 6 covered the historical risks associated with centralized exchanges, referencing well documented cases like Mt. Gox in 2014 and FTX in 2022. Reason 7 explained leverage and margin trading and how liquidation can wipe out an entire investment during completely ordinary market volatility. Reason 8 discussed the often overlooked impact of trading fees and tax obligations on overall investment performance. Reason 9 covered the risks of insufficient diversification and overly concentrated positions. And reason 10 discussed the importance of having some kind of general plan or exit strategy decided in advance rather than making purely reactive decisions in the moment. Now let's move into a section addressing some of the most common questions beginners ask when they are first learning about cryptocurrency. Because I think answering these directly and honestly will help reinforce everything we have covered so far. A common question is cryptocurrency a scam? The honest fact based answer is that cryptocurrency as a broad technology and asset class is not inherently a scam. Bitcoin, Ethereum, and many other established cryptocurrencies are real, functioning technologies with well documented histories, active development communities, and legitimate use cases. Even though reasonable people can do disagree about their long term value and usefulness. However, the cryptocurrency space does contain a significant number of specific scams, fraudulent projects, and bad actors, as we discussed extensively earlier in this episode. So, the more accurate, nuanced answer is that cryptocurrency as a technology is legitimate and real, but the space also contains real, well documented risks and fraudulent activity that beginners need to be aware of and cautious about. The common question is, should I invest in cryptocurrency? This is a question I genuinely cannot answer for you. And honestly, nobody without full knowledge of your personal financial situation should be answering it for you either. Whether cryptocurrency is an appropriate investment for any individual person depends on factors like their overall financial situation, their existing debts, their emergency savings, their retirement planning, their personal risk tolerance, and their broader financial goals. This is exactly the kind of decision that's best made in consultation with a licensed, qualified financial advisor who can look at your complete financial picture rather than based on general information from an educational podcast. A common question is, how much money should I start with? Again, this isn't something a general educational resource can responsibly answer for any specific individual, because it depends entirely on personal financial circumstances. What we can say based on widely accepted general financial principles rather than personalized advice is that many financial educators suggest that if someone chooses to invest in a highly volatile speculative asset class, it's often approached with a relatively small portion of someone's overall discretionary funds, money that's genuinely not needed for essential expenses, debts, or emergency savings, precisely because of the well documented volatility and risk involved. A common question is, what's the difference between Bitcoin and other cryptocurrencies? Bitcoin was the first cryptocurrency and remains the largest by total market value, a measure often called market capitalization. It's generally viewed, even among critics, as having the longest track record, the most established network, and the most widely recognized brand within the cryptocurrency space. Other cryptocurrencies, sometimes broadly called altcoins, vary enormously in their purpose, their level of development, their community size, and their track record. Some, like Ethereum, have existed for many years, have extensive real world development activity, and are widely used to power other applications. Others are extremely new, have little or no real usage, and exist primarily as speculative assets with prices driven mostly by social media attention and trading activity rather than any underlying utility. This is exactly why the research principles we discussed earlier apply differently depending on which specific type of cryptocurrency someone is considering. A well established long running project with years of development history carries a different risk profile than a brand new token that launched last week with no track record at all, even though both can still experience significant price volatility. A common question is, can I lose more money than I put in? For most straightforward cryptocurrency purchases where someone simply buys and holds an asset without using leverage or margin, the maximum possible loss is generally limited to the amount of money originally invested. The value can go to zero in theory, but it generally cannot go below zero for a simple purchase. However, as we discussed earlier, leverage and margin trading introduce a different risk profile, where in some circumstances, depending on the specific platform and product, it's possible to lose more than the initial amount put in, which is exactly why leverage trading carries such an elevated risk warning throughout the financial industry, not just within cryptocurrency specifically. A common question is it too late to get involved with cryptocurrency? This question comes up constantly, and I want to address it directly and honestly. Nobody, including financial professionals, economists, or crypto industry experts, can reliably predict future price movements of any cryptocurrency. Some argue that established cryptocurrencies still have significant room for future growth, while others argue that much of the easy growth already happened years ago and future returns may be more modest or more volatile going forward. Both of these are opinions. These are opinions, not established facts, and reasonable, well informed people genuinely disagree on this question. Anyone who tells you with total certainty that it's either definitely too late or definitely a perfect time to get involved is expressing a personal opinion, not a verified fact, regardless of how confidently they present it. Let's move now into a myth versus fact section, where I want to directly address some of the most common misconceptions beginners have about cryptocurrency, clearly separating what's actually documented and verifiable from what's simply a common misunderstanding or exaggeration. Myth: cryptocurrency is completely anonymous, so nobody can ever trace what you do with it. Fact: most major cryptocurrencies, including Bitcoin, actually operate on public, transparent blockchains, meaning every single transaction is publicly visible and permanently recorded, though the identities behind wallet addresses aren't automatically displayed. This is sometimes described more accurately as pseudonymous rather than fully anonymous. Law enforcement agencies and blockchain analytics companies have developed sophisticated tools that have successfully traced and identified individuals behind supposedly anonymous transactions in numerous well-documented criminal investigations. So while your everyday identity isn't automatically attached to a wallet address, the idea that cryptocurrency transactions are completely untraceable is a widespread myth, not an accurate fact. Myth: cryptocurrency has no real world use beyond speculation. Fact: this is more accurately described as a matter of ongoing debate rather than a settled fact in either direction. It is true and well documented that a significant portion of current cryptocurrency trading activity is speculative in nature, meaning people are primarily buying and selling based on anticipated price movements rather than using the currency for everyday purchases. However, it's also documented that cryptocurrency and blockchain technology have real functioning use cases beyond pure speculation, including cross-border money transfers, certain decentralized financial applications, and use in countries experiencing severe currency instability or limited access to traditional banking services. Reasonable people disagree about how significant or widespread these use cases currently are compared to speculative trading activity, and that disagreement itself is a matter of ongoing opinion and debate, not something with one universally agreed upon answer. Myth: you need to buy a whole Bitcoin to invest in it. Fact. This is factually incorrect. Bitcoin, like most cryptocurrencies, can be purchased and owned in extremely small fractional amounts. The smallest unit of a Bitcoin is called a Satoshi, named after Bitcoin's creator, and one Bitcoin is divisible into 100 million Satoshis. This means someone can purchase a very small dollar amount of Bitcoin well under the price of a single whole coin, which many beginners don't initially realize. Myth: cryptocurrency prices only go up over time. Fact: this is clearly false and easily disproven by widely available documented historical price data. Cryptocurrency markets, including Bitcoin specifically, have experienced multiple well documented periods of severe prolonged price declines throughout their history, sometimes losing a majority of their value over the course of many months before eventually recovering, and in some cases never recovering to previous levels at all, depending on the specific asset. The overall long-term price trend of established cryptocurrencies like Bitcoin has generally been upward since their creation, but this has happened alongside significant, sometimes extended periods of severe decline and past performance. As financial professional consistently emphasize, is never a reliable guarantee of future results. Myth: mining cryptocurrency is how most people obtain it today. Fact: mining refers to the process by which certain cryptocurrencies, including Bitcoin, are created and transactions are verified using specialized computer hardware to solve complex mathematical problems. In Bitcoin's early years, individual hobbyists could meaningfully participate in mining using regular home computers. Today, however, Bitcoin mining has become dominated by large specialized industrial operations using highly advanced, expensive equipment, making it largely impractical for an average individual beginner to meaningfully mine Bitcoin from home. Most beginners today obtain cryptocurrency by purchasing it directly through an exchange, not through mining. Let's talk now about some practical safety principles, pulling together everything we have discussed into a clear, actionable framework described in plain conversational terms rather than as a rigid checklist before ever putting real money into cryptocurrency. It's worth taking time to genuinely understand what you are buying, including who created it, how long it has existed, and what problem it claims to solve, rather than buying based purely on hype or a hot tip from social media. It's worth having an honest conversation with yourself and ideally with a qualified financial professional about whether the money you are considering using is money you could genuinely afford to lose entirely without disrupting your essential living expenses or your financial security. It's worth staying deeply skeptical of anyone or anything that guarantees specific investment returns, regardless of how credible or confident they appear. Since legitimate investments never come with guarantees, it's worth being cautious of urgency and pressure tactics, since scammers frequently rely on creating false time pressure to prevent careful thinking. It's worth understanding and securely protecting your private keys and seed phrase if you move cryptocurrency into a personal wallet, never sharing this information with anyone under any circumstances, and never storing it in an easily accessible digital location like an unencrypted photo or note. It's worth understanding the specific risks of leverage and margin trading before ever using these tools, given how consistently and severely they have been documented to harm inexperienced traders. It's worth tracking your transactions for tax purposes and consulting a qualified tax professional about your specific obligations, since cryptocurrency transactions can create tax consequences that many beginners don't anticipate. And it's worth considering cryptocurrency if you choose to engage with it all as one small piece of a much broader financial picture rather than concentrating a large portion of your available resources into a single highly volatile asset. Let's spend some time now talking about the emotional and psychological side of investing, because it is a topic that doesn't get nearly enough attention in most cryptocurrency education content, and I genuinely believe it's just as important as any of the technical concepts we have covered. Financial markets and cryptocurrency markets in particular, given their extreme volatility, can trigger powerful emotional responses in almost everyone, regardless of experience level. Watching an investment's value rise rapidly can trigger excitement, euphoria, and a strong desire to invest even more money to capture additional gains. Watching an investment's value fall rapidly can trigger fear, anxiety, and a strong urge to sell immediately to stop the emotional discomfort of watching further losses accumulate. Understanding that these emotional responses are a completely normal, universal part of human psychology rather than a personal weakness or failure is actually an important first step toward managing them more effectively. Uh, Behavioral finance, which is a well established academic field studying the psychology behind financial decision making, has extensively documented these patterns across many types of markets and many different groups of people, not just cryptocurrency investors specifically. Concepts like loss aversion, which describes how the emotional pain of losing money tends to feel more intense than the emotional pleasure of gaining an equivalent amount of money, and herd behavior, which describes our tendency to follow the crowd even when it may not be in our own best interest, are well documented, extensively researched psychological phenomena, not just casual observations. Given how universal these emotional responses are, one of the most practical things a beginner can do is build in some kind of buffer between an emotional impulse and an actual financial action. This might mean deciding in advance during a calm state of mind what circumstances would lead to buying or selling rather than making that decision reactively in the middle of a strong emotional moment. It might mean stepping away from constantly checking prices throughout the day, since research on trading behavior has shown that more frequent price checking tends to correlate with more frequent, often less disciplined trading activity. It might mean recognizing the specific feeling of fear of missing out than it arises and treating that feeling as a signal to slow down and research more carefully rather than a signal to act immediately. Let's take another recap here, since we have covered a significant amount of additional material. We addressed several of the most common beginner questions, including whether cryptocurrency is a scam, whether someone should invest how much money to start with, the differences between Bitcoin and other cryptocurrencies, whether losses can exceed the initial investment, and whether it's too late to get involved, consistently emphasizing that many of these questions don't have one universally correct answer and depend on personal circumstances, best discussed with a qualified financial professional. We then worked through a myth versus fact section, clarifying that cryptocurrency transactions are pseudonymous rather than fully anonymous, that the debate over real world utility versus pure speculation remains genuinely unsettled and disputed among experts, that Bitcoin can be purchased in extremely small fractional amounts, that cryptocurrency prices have experienced well documented several declines throughout history despite an overall upward long term trend, and that mining today is largely dominated by large scale industrial operations rather than individual hobbyists. We then walked through a practical safety framework, pulling together research habits, honest self assessment of affordable risk, skepticism towards guarantees and urgency, private key security, awareness of leverage risk, tax record keeping, and diversification. And we just finished discussing the psychological and emotional side of investing, including well documented concepts like loss aversion and herd behavior, and practical ways to create distance between emotional impulses and actual financial decisions. Now let's take a step back and talk about how the broader cryptocurrency market tends to move in cycles, because understanding this pattern helps explain why so many beginners specifically enter the market at the worst possible times through no fault of their own intelligence or effort, but simply due to how human attention and media coverage tend to work. Cryptocurrency markets, like many other markets, have historically moved through periods of significant price increases, sometimes called bull markets, followed by periods of significant price decreases, sometimes called bear markets. This pattern is well documented throughout the history of Bitcoin and the broader cryptocurrency market, with several distinct cycles having occurred since Bitcoin's creation. During bull markets, prices rise substantially, media coverage of cryptocurrency increases dramatically, and stories of significant profits become widely shared and discussed both online and through traditional news coverage. This increased attention naturally draws in large numbers of new beginners who are hearing about cryptocurrency for the first time, often specifically because prices have already risen substantially and generated exciting headlines and social media buzz. Here's the critical insight that connects directly back to our central topic today, because beginners are naturally drawn in by rising prices and exciting media coverage. A large proportion of first time crypto investors historically enter the market during the later stages of a bull market, when prices have already risen substantially, rather than at the beginning of a bull market when prices are relatively low. This isn't a coincidence or bad luck specific to any individual. It's a structural, well documented pattern connected to how human attention and media coverage naturally works. Nobody writes exciting news headlines about cryptocurrency during quite low price periods. The exciting headlines and social media buzz specifically emerge during and after the significant price increases, which is exactly when the asset has already become more expensive and historically has often been closer to a period of decline than a period of continued rapid growth. Following a period of significant price increases, cryptocurrency markets have historically experienced substantial price corrections or prolonged downturns, sometimes called bear markets or crypto winters, a term that's become commonly used within the industry to describe extended periods of declining or stagnant prices after lasting many months or even years. Beginners who entered near the peak of the previous bull market, precisely because that's when they first heard about cryptocurrency and felt the strongest pull of excitement and fear of missing out, are then the ones most directly exposed to these subsequent downturns, often experiencing significant losses relatively soon after their very first investment. This cyclical pattern, combined with the natural timing of media attention and beginner entry points, helps explain at a structural level why such a large proportion of first-time investors specifically end up losing money entirely separate from any of the individual mistakes we discussed earlier in this episode. Even a beginner who did everything else reasonably well, researched their investment, avoided obvious scams, invested only money they could afford to lose, and avoided leverage entirely, can still experience a loss on their first investment simply due to unfortunate timing connected to this broader market cycle, which is largely outside of any individual's control or predictive ability. Understanding this pattern doesn't mean you should try to perfectly time the market. Buying only at the exact bottom of a cycle and selling only at the exact top, because reliably predicting these turning points in advance has proven extremely difficult even for professional analysts and researchers who study these markets full time. What understanding this pattern does provide is realistic, grounded expectations. If you understand that first time losses are historically common, partly due to structural market timing patterns that have nothing to do with individual mistakes, you are less likely to interpret an early loss as profit than you're personally bad at investing, or that cryptocurrency itself is entirely worthless, and more likely to view it as a normal, well documented part of how these particular markets have historically behaved. Let's shift gears now and talk about a topic that connects several threads we have already discussed, which is the specific role that social media plays in shaping beginner behavior in cryptocurrency markets. Social media platforms have become one of the primary ways that people, especially younger investors, first learn about and get drawn into cryptocurrency. This is a well documented trend discussed extensively in financial research and mainstream news coverage of the crypto industry. Social media creates a unique set of dynamics that can significantly distort a beginner's perception of risk and typical outcomes. One significant dynamic is what researchers sometimes call survivorship bias, applied specifically to social media content. People who make significant profits from a cryptocurrency investment are naturally far more motivated to post about their success publicly, sharing screenshots of gains and celebrating their wins, compared to people who lost money, who are generally far less motivated to publicly share their losses, often out of embarrassment or simply a lack of interest in discussing a negative experience. This creates a skewed, unrepresentative picture of typical outcomes when you scroll through social media content about cryptocurrency. You're disproportionately seeing the success stories, while the far more common experiences of modest losses, break even results, or significant losses remain largely invisible, hidden behind the much louder, much more visible stories of success. Another significant dynamic involves paid promotion and financial incentives that aren't always clearly disclosed to viewers. Some individuals who promote specific cryptocurrencies on social media are being paid directly by the project's creators to generate hype and attention, sometimes without clearly disclosing this financial relationship to their audience, which, depending on the specific circumstances, may violate disclosure regulations enforced by agencies like the Securities and Exchange Commission, commonly known as the SEC, which has taken documented, publicly reported enforcement actions against certain individuals and companies for exactly this kind of undisclosed promotional activity in the past. Other promoters may have already purchased large amounts of a specific coin before promoting it publicly, meaning they directly benefit financially when their promotion causes the price to rise as new buyers drawn in by the hype purchase the coin and push its price upwards, allowing the earlier undisclosed holder to sell their own holdings at a profit. Given these documented dynamics, a healthy protective habit for any crypto beginner is approaching social media content about cryptocurrency with a significant degree of skepticism, specifically asking questions like, does this person have a financial incentive to promote this particular coin, and are they disclosing that incentive clearly, and am I seeing a realistic representative picture of typical outcomes, or primarily a highlight reel of the most exciting, most unusual success stories? Let's now spend some time discussing the specific concept of decentralized finance, often abbreviated as DEFI, because this is an area that has grown significantly within the cryptocurrency space and presents its own unique set of risks that beginners specifically need to understand, separate from simply buying and holding a cryptocurrency like Bitcoin. Decentralized finance refers to a broader category of financial applications built on blockchain technology, primarily on networks like Ethereum, that aim to recreate traditional financial services like lending, borrowing, and trading without relying on traditional banks or financial institutions as intermediaries. Instead, these services are powered by smart contracts, the self executing pieces of code we discussed earlier in this episode. For example, a decentralized lending platform might allow someone to lend their cryptocurrency to other users and earn interest, or to borrow cryptocurrency by providing other cryptocurrency as collateral, all managed automatically through smart contract code rather than through a bank's loan officer and internal approval process. This can offer certain benefits like operating continuously without traditional banking hours and potentially offering services to people who don't have access to traditional banking infrastructure in their country. However, decentralized finance also introduces specific, well documented risks that beginners often don't fully understand before participating. One significant risk involves smart contract vulnerabilities, because smart contracts are pieces of software code. They are potentially they can potentially contain bugs, errors, or security vulnerabilities just like any other piece of software. These have been numerous well documented publicly reported incidents. There have been numerous well documented publicly reported incidents throughout the history of decentralized finance where hackers discovered and exploited vulnerabilities in a smart contracts code, resulting in a loss of large amounts of user funds, sometimes worth many millions of dollars in a single incident. Unlike a traditional bank where a security breach can be covered by insurance or absorbed by the institution itself, losses from decentralized finance smart contract exploits are often permanent and unrecoverable for the affected users, since there's typically no central institution responsible for reimbursing losses. Another significant risk involves what's sometimes called impermanent loss, a somewhat technical concept related to a specific type of decentralized finance activity called providing liquidity, where users contribute pairs of different cryptocurrencies to a pool that facilitates trading for other users, earning a share of trading fees in return. Depending on how the prices of the two different cryptocurrencies in that pool move relative to each other, a liquidity provider can end up with a total value lower than if they had simply held the same assets separately without providing liquidity at all. A nuanced risk that many beginners don't fully understand before participating. Given the significant technical complexity and documented risks associated with decentralized finance, specifically, this is an area where the research principles we discussed earlier become even more important, not less. A beginner considering any decentralized finance platform would benefit from taking significant additional time to understand exactly how a specific platform works, what happens to their funds in various scenarios, whether the platform's smart contract code has been independently reviewed by security researchers through a process called an audit, and what the platform's track record has been before committing any meaningful amount of money. Let's talk now about non-fungible tokens, commonly known as NFTs, since this is another area within the broader cryptocurrency space that received enormous public attention and media coverage, and that has caught many beginners in speculative patterns similarly to those we discussed earlier regarding cryptocurrency tokens generally. A non-fungible token is essentially a unique digital certificate of ownership recorded on a blockchain, often associated with a specific digital image, piece of art, video, or other digital item. The word fungible refers to something that can be exchanged for an identical equivalent like a dollar bill, where any $1 bill is functionally identical to another dollar bill. Non-fungible means the opposite. Each token is considered unique and not directly interchangeable with another. During a significant period of heightened public attention, often associated with years 2021 and 2022, NFTs experienced an enormous surge in popularity, with certain digital collections selling for extremely large sums of money. Generally widespread media coverage and significant public interest, many beginners drawn in by this media attention and by stories of dramatic profits purchased NFTs during this period to intense hype, often paying significantly inflated prices driven primarily by speculative excitement and social media attention rather than any clearly established durable value. Following this period, NFT trading volumes and prices experienced a well-documented significant decline across the broader market, with many specific NFT collections losing the vast majority of their previous value, leaving many beginners who purchased during the peak of the hype holding digital items worth dramatically less than what they originally paid. This pattern closely mirrors the pump and dump and hype-driven dynamics we discussed earlier regarding cryptocurrency tokens generally. Simply applied to a different specific type of digital asset, the underlying lessons remain consistent throughout this entire episode. Assets that experience rapid, dramatic price increases driven primarily by social media hype and speculative excitement rather than clearly established durable underlying value or utility, carry a well-documented elevated risk of significant subsequent price declines. Price declines regardless of whether we are discussing a specific cryptocurrency token or an NFT collection. Let's take another recap since we have now covered several additional important areas. We discussed the concept of market cycles, explaining how bull markets and bear markets have historically alternated throughout cryptocurrencies history, and how this cyclical pattern combined with the natural timing of media attention tends to draw large numbers of beginners to the market, specifically near price peaks, contributing structurally to the widespread pattern of first-time investment losses separate from any individual mistakes a beginner might make. We then discussed the specific role of social media in shaping beginner perceptions, covering survivorship bias in shared content and undisclosed financial incentives behind certain promotional posts. We covered decentralized finance, explaining smart contract based lending and borrowing, along with documented risks like smart contract vulnerabilities and impermanent loss. And we covered non-fungible tokens, explaining what they are and how they experience a similar hype during boom and subsequent decline pattern to many speculative cryptocurrency tokens. Now let's spend some time discussing a topic that I think is genuinely important for beginners to understand clearly, which is the current regulatory environment surrounding cryptocurrency in the United States, described in general factual terms, since this is an area that continues to evolve over time. Cryptocurrency regulation in United States involves multiple different federal agencies, each with their own areas of focus and authority. The Securities and Exchange Commission, the SEC, has taken the position in various public statements and enforcement actions that certain cryptocurrency tokens may qualify as securities under existing federal law, which would subject them to specific registration and disclosure requirements. The Commodity Futures Trading Commission, commonly known as the CFTC, has taken the position that certain cryptocurrencies, including Bitcoin, specifically function more like commodities similar to gold or oil, placing them under a different regulatory framework. The exact regulatory classification of many specific cryptocurrencies remains a genuinely debated and evolving area, with different agencies, courts, and legal experts sometimes reaching different conclusions on similar questions, and with the overall regulatory landscape continuing to develop and change over time through new legislation, court rulings, and agency guidance. Because this regulatory environment continues to evolve, it's genuinely difficult to provide permanently accurate specific regulatory information within an educational podcast that might be listened to well after it was originally recorded. What remains consistently true, regardless of how specific regulations evolve over time, is that beginners should be aware that regulatory uncertainty itself represents a documented risk factor within the cryptocurrency space. Changes in regulation can potentially affect the legality, taxation, and trading availability of certain cryptocurrencies or platforms, and staying reasonably informed about the current regulatory environment, ideally through reputable financial news sources, and when relevant to your personal situation, through consultation with a qualified legal or financial professional, is a reasonable practice for anyone engaging with this space. Let's move now into a discussion about a concept that's extremely relevant to understanding beginner losses, specifically, which is the difference between investing and trading. Since beginners often conflate these two very different approaches without realizing it's investing in the traditional sense used throughout mainstream finance generally refers to purchasing an asset with the intention of holding it for a longer period of time, often years, based on a belief in its longer term value or potential, and generally involves less frequent buying and selling activities. Trading, by contrast, generally refers to buying and selling an asset more frequently, often within days, hours, or even minutes, attempting to profit from short term price movements rather than long term value changes. These two approaches carry meaningfully different risk profiles and require meaningfully different skill sets, yet many beginners enter cryptocurrency without clearly deciding which approach they are actually taking, and end up drifting between the two in a way that combines the downsides of both without clearly benefiting from the strengths of either. A beginner might initially intend to simply buy and hold an investment for the long term, but then, upon seeing short term price movements, begin reactively buying and selling based on those short term fluctuations, effectively becoming an unplanned, undisciplined trader without ever making a deliberate decision to take on that different, generally higher risk and higher skill activity. Short-term trading in particular has been extensively studied by financial researchers across many different markets, not just cryptocurrency, and this research has fairly consistently documented that the significant majority of retail traders, meaning everyday individual traders rather than large financial institutions, underperform simple long-term buy and hold approaches over time, largely due to a combination of transaction costs, emotional decision making, and the extreme difficulty of consistently predicting short term price movements, even for highly experienced professional traders. This isn't a cryptocurrency specific finding, it's a broadly documented pattern across stock markets, foreign currency markets, and various other financial markets that have been studied extensively by academic researchers over many decades. Given this well documented research, a beginner who finds themselves drifting in frequent short term trading without having deliberately decided to take on that generally higher risk activity, and without having developed the specific skills and disciplined approach it requires, is engaging in a pattern that has been fairly consistently associated with underperformance across many different financial markets throughout history. This doesn't mean short term trading is impossible to do successfully, since some individuals clearly do develop genuine skill and discipline in this area over time. It simply means that beginners specifically tend to drift into this pattern unintentionally and tend to underperform when they do so based on extensively documented broad financial research. Let's talk now about a specific concept called dollar cost averaging, since this is a widely discussed strategy within long term investing, generally, including within cryptocurrency specifically, and understanding it provides a useful contrast to the emotionally reactive trading patterns we have discussed throughout this episode. Dollar cost averaging refers to the practice of investing a fixed amount of money at regular predetermined intervals, for example, a set amount every single week or every single month, regardless of what the current price happens to be at that particular moment, rather than trying to time the market by attempting to predict the best specific moment to invest a larger lump sum all at once. The general logic behind this widely discussed approach is that by investing a fixed amount consistently over time, an investor naturally buys more of an asset when its price is lower and naturally buys less of that same asset when its price is higher, which can result in a more moderate averaged out purchase price over time compared to attempting to time a single large purchase at what might turn out to be an unfavorable moment. This approach also has a documented psychological benefit, since it removes some of the pressure and emotional decision making involved in trying to identify the perfect moment to invest, an emotional dynamic we discussed extensively earlier in this episode. It's important to note as a fact rather than an opinion that dollar cost averaging does not guarantee profit and does not protect against losses in a market that experiences a sustained prolonged decline over the entire period someone is investing. It's simply a widely discussed structured approach that can help reduce the specific risk of investing a large lump sum entirely at an unfavorable, poorly timed moment, and can help reduce some of the emotional reactive decision making that tends to hurt beginners specifically. We are now getting toward the later portion of our discussion together. So let's take a comprehensive recap of everything we have covered across this entire episode, pulling all of these different threads together into a cohesive whole. We began by exploring the fundamental nature of money and the historical origins of Bitcoin, connecting its creation to the 2008 financial crisis and explaining blockchain technology throughout the shared notebook analogy. We then worked systematically throughout 10 major well-documented reasons why beginners specifically tend to lose money on their first cryptocurrency investment, covering lack of research, emotional decision making, investing unaffordable money, falling victim to scams, poor private key security exchange related risks, dangerous leverage trading, overlooked fees and taxes, insufficient diversification, and lacking any general exit strategy. We addressed common beginner questions, worked through a myth versus fact section, correcting common misconceptions, and outlined a practical safety framework, pulling all of these lessons together into actionable general principles. We then explored the psychological and emotional dimensions of investing, examined how market cycles and social media dynamics structurally contribute to poor beginner timing, and covered specific additional risk areas including decentralized finance and non-fungible tokens. Most recently, we discussed the evolving regulatory environment, the important distinction between investing and trading, and the widely discussed concept of dollar cost averaging as a structured, disciplined alternative to emotionally reactive decision making. As we move toward wrapping up this episode, I want to spend some time discussing what a more thoughtful, educated approach to cryptocurrency might realistically look like for a beginner, not as specific personalized advice since I'm not able to provide that, but as a general illustration of how someone might apply everything we discussed today in a more deliberate, informed way compared to the reactive, hype driven patterns that lead to widespread losses we have spent this entire episode discussing. A more educated approach generally begins with taking meaningful time to understand the fundamentals before ever committing real money, which is exactly what we have spent these first several hours working through together. This includes understanding what blockchain technology actually is, understanding the specific project or cryptocurrency being considered, and understanding the well documented risks specific to this asset class, including volatility, scams, security requirements, and the psychological challenges of navigating an extremely volatile market. It generally includes an honest, calm assessment, ideally with input from a qualified financial professional, of how much money, if any, might reasonably be considered discretionary and genuinely affordable to lose entirely, completely separate from money needed for essential living expenses, debt obligations, or emergency savings. It generally includes deciding on a general approach in advance during a calm state of mind, whether that involves a long-term holding approach, a structured strategy like dollar cost averaging, or a clear decision to avoid short-term trading and leverage entirely, given the well-documented risks we discussed regarding those specific activities. It generally includes taking meaningful security precautions, understanding private keys and seed phrases clearly, and applying healthy, informed skepticism toward guaranteed returns, unsolicited investment opportunities, and hype-driven social media promotion. And it generally includes maintaining realistic expectations, understanding that losses are a well-documented common part of investing in any volatile asset, including for experienced, educated investors, and that no amount of education can eliminate risk entirely, only reduce the likelihood of falling into the most common, well-documented, and often entirely avoidable beginner traps we have spent this episode discussing in detail. Let's talk about what our next episode in this series will cover, building directly on everything we have discussed today. In our next episode, we are going to take a much deeper look specifically at how cryptocurrency and the exchanges work, walking through from complete first principles exactly what happens behind the scenes when you buy and sell cryptocurrency, how to evaluate and compare different exchanges based on documented factors like security history, regulatory compliance, and fee structures, and how to understand the practical account verification and security setup process that most legitimate exchanges require, including a detailed, beginner-friendly explanation of two-factor authentication and why it represents such an important security practice. We will also spend meaningful time exploring personal wallets in much greater technical detail, including a clear practical comparison between software wallets and hardware wallets, and a step-by-step conceptual walkthrough of how someone might reasonably move cryptocurrency from an exchange into their own personal wallet for the first time, along with the specific security considerations involved at each step of that process. Before we close out today's episode, let's do one final complete summary, pulling together the absolute key takeaways from everything we have covered across these past 3 hours, so that even if this is the only portion of the entire episode you remember clearly, you will walk away with the most essential practical information. Cryptocurrency emerged from a legitimate technological innovation born out of a specific historical moment following the 2008 financial crisis, using blockchain technology to create a decentralized, transparent, shared ledger system that doesn't rely on any single controlling institution. The commonly cited statistic that a very large majority of beginners lose money on their first cryptocurrency investment, whether the precise figure is closer to 80% or 95%, depending on the specific source, reflects a well documented, widely observed pattern rather than one single official government statistic, and the underlying reasons behind this pattern are well understood and importantly largely avoidable through education. The 10 major reasons we identified throughout this episode were a lack of basic research before investing, emotionally driven decision making rather than a calm and deliberate plan, investing money that couldn't genuinely be afforded to lose, falling victim to well documented scam patterns including guaranteed return schemes and romance scams, poor personal security practices around private keys and seed phrases, underestimating the well documented risks associated with centralized exchanges, misunderstanding the significant dangers of leverage and margin trading, overlooking the cumulative impact of fees and tax obligations, insufficient diversification through overly concentrated positions, and a complete lack of any general exit strategy decided in advance. Beyond these 10 specific individual mistakes, we also discuss structural factors completely outside of any individual beginner's control, including the natural way that cryptocurrency market cycles and media attention tend to draw large numbers of new beginners into the market, specifically near price peaks, and the way social media dynamics like survivorship bias and undisclosed financial incentives can create a significantly distorted, unrealistic picture of typical investment outcomes. We covered practical security principles, addressed common beginner questions honestly and directly, and worked through a myth versus fact section, correcting widespread misconceptions, and discussed additional risk areas including decentralized finance and non-fungible tokens. We also touched on the evolving regulatory environment, the important distinction between investing and trading, and the widely discussed concept of dollar cost averaging as one possible structured, disciplined approach among several that exist within long-term investing. The single most overarching theme running throughout this entire 3-hour discussion is this: education, practice, and deliberate, unemotional decision making, made calmly and in advance rather than reactively in the heat of the moment, represent the most effective, well documented tools available for avoiding the most common well established beginner mistakes in cryptocurrency. This doesn't guarantee success, and nothing in the financial world can honestly guarantee success given the fundamentally unpredictable nature of markets, but understanding these well documented patterns dramatically shifts the odds in your favor compared to entering this space blindly driven purely by hype, social media excitement, and fear of missing out, which is exactly the pattern we have spent this entire episode carefully unpacking together. Thank you so much for spending these past 3 hours with me, working through this material carefully and thoroughly from the very first principles. I know this was a long, dense discussion covering a tremendous amount of ground, but cryptocurrency is a genuinely complex topic, and rushing through it superficially would have done you a real disservice, especially given how much money beginners have historically lost by engaging with this space without proper foundational understanding. Before we go, I want to leave you with the same reminder we started with, because it's genuinely the most important things to take away from this entire episode. Everything discussed today is for educational purposes only. This is not financial advice, not legal advice, and not tax advice. Cryptocurrency is a highly volatile, speculative asset class, and historical patterns, including the specific historical patterns and statistics we discussed today, do not guarantee any specific future outcome. Please consult with a licensed, qualified financial professional before making any investment decisions, and never invest money that you cannot genuinely afford to lose. Thank you again for listening, and I'll see you in the next episode, where we will take a deep practical dive into exchanges and personal wallets, building directly on everything we have established together today. If this episode helped you, please do subscribe now or hit the notification button, and it will help me grow this podcast easily.